Welcome again, neighbors, to Indianapolis Neighborhood Resource Center. And this is the July session for the for info sessions. And we are delighted to have you. As you settle in, if you would, again, please mute your microphones so that we can cut back on the feedback during the presentation. At INRC, our goal is to increase neighborhood engagement in Indianapolis neighborhoods. It's also to strengthen leadership skills in neighborhood leaders and to expand community building activities in our neighborhoods. My name is Terry Brooks Allen, and I am the training manager at INRC. And I'm joined by Danae Freeman, if you'd give us a wave, Danae. And Danae is our engagement manager at INRC. So all of the great artwork and social work, social network platforms, Danae does all of that work. So she does a really great job for us at INRC.
Thank you, Terry. Thanks
Tonight,
for joining us.
thank you, Danae. Tonight, we are excited to share with you the Department of Metropolitan Development with the City of Indianapolis. Let me adjust my screen. Beth Neville is hold on one second. Beth, I can't grab my notes here.
Okay.
Okay, let me try this.
If it makes life easier, Terry, I can do my introduction.
Okay, if you would, because I try to do a
Yes.
split screen, and for some reason I can't get it to go smaller. Thank you.
Oh yeah, no problem. I have a bad habit of having 8 billion windows open, and then when I try and do the snap screen, it gets lost. So
Yeah.
hi everybody, thank you for having me tonight. My name is Beth Neville, and I'm the Administrator of Community Investments with the Department of Metropolitan Development with the City of Indianapolis. So with that, Terry, did you want me to go ahead and start sharing my screen? Did you have any other intros?
Yes, no.
Okay, perfect. Let me do that real fast. Okay. All right, so perfect. I'm assuming you guys can now see the presentation, correct?
Yes.
Okay, thank you. Okay, so for a little bit more context, I actually just recently moved into this administrator role, but I've now been with the city for about 6 years in a few different positions. I actually started as the Community Development Block Grant Manager, which is one of the grants that we'll be talking about tonight that you guys will be able to be experts in walking out of tonight's session. So now in this role, I get to work with all the grants that the city receives from HUD for housing, community development, and homelessness. So today, I'm going to start by giving an overview of affordable housing. And to do so, we'll start with some context and a foundation for the discussion. Then I'll give an overview of the HUD grant funding that their city receives each year. Then we'll do a quick overview of how affordable housing subsidy works. So if you have developers coming to your neighborhood, to have a little bit more context about what they're talking about when they're throwing out all these numbers. We'll then go into a quick overview of the Continuum of Care, and that's the collective approach to end homelessness within Indianapolis. We'll then end with an overview of some recent challenges and accomplishments, with plenty of time for a Q&A at the very end. All right, so with that, we'll dive into things. Before digging into a lot of the weeds, and we will pull out a little bit of math today, I wanted to start with some context and history for affordable housing in the US. So the programs and agencies that eventually became HUD began in the early 1930s. They were created to alleviate some of the housing hardships caused by the Great Depression. And at the time, affordable housing was largely provided through public housing complexes. However, in the late 1970s, this model began to change. And that's when many of the programs that I'll discuss today actually began. So this was largely the model change was due to some changing politics, as well as some well-known notable failures. I'm actually from St. Louis originally, and the images on the screen are actually of Pruitt-Igoe, one of the most famous public housing failures in U.S. history. There is an awesome documentary called The Pruitt-Igoe Myth. If you're interested in learning more on it, it is foundational to St. Louis. And so it's interesting context given it's kind of a peer city of Indianapolis. So that's a little bit of background about the history of affordable housing in the US. I also want to acknowledge some major things that have impacted housing in this country. There could be entire sessions dedicated to these topics, but unfortunately, we only have a little bit of time this evening, so I won't have time to dive into all of these, but I do want to acknowledge that they have profoundly influenced housing and poverty in this country. First is redlining. That term refers to the discriminatory practice of systematically denying financial services to residents of certain areas based on race and ethnicity. Essentially, the federal government fueled segregation and disinvestment in communities of color through mortgages and lending for decades and decades. And it was not until the Fair Housing Act was passed in 1968, and really truly up until that time, it was completely lawful to discriminate in housing. So you can still today see some of the legacy racially restrictive covenants on properties within our own community. So I just want to acknowledge that those are major players within the space. I don't have time to dig into it, but there's lots and lots of documentaries and books on these topics if you're interested in learning more. I also think I want to acknowledge that many within the housing industry would argue that access to home ownership opportunity, which had been denied for decades and decades to Black residents, communities of color, that has been a primary driver of wealth inequality in America. So I wanted to set that as a little bit of a grounding framework for the conversation today. I also want to talk, before we dive into a lot of the affordable housing nitty-gritty, to talk about some of the economic realities of housing. First, it's important to understand that private market rate rents can only go so low. Private landlords will not and cannot provide very low rents at scale, and I'll explain kind of why over the next two slides. Fundamentally, operating a private rental property is a business. If an owner can't cover their costs and make a return on their investment, it doesn't make any sense for them to be a landlord. And that's just kind of how the economics of this housing industry work. So landlords need to be able to cover their operating costs, such as maintenance and insurance. They have to be able to cover repairs. So if a furnace goes out in the winter, they need to pay their taxes, property taxes. They may have also gotten a loan from a bank to purchase the property, and they have to be able to make that payment back to the bank. And then they also need to see a return on their investment for there to be a reason for there to be private market activity in housing. So here's an example of kind of what that budget might look like. And I want to acknowledge this is an example from 2019, which just further illustrates the point given how drastically housing has changed since the pandemic. So let's assume that a small landlord purchases a home for $50,000. Let's just assume that they do not have a loan on the property, that they just bought it outright. If it costs $300 per month for operating, $75 for property taxes, you have to assume some kind of vacancy. So you could have a tenant move and you don't get to collect rent some months. You may have a tenant who passes away and you have to refill that unit. That's just part of it, is there's going to be some vacancy in your property. You also need to see that modest return on investment. And given all of that, with a $50,000 kind of investment by the landlord, the baseline rent would have to be $789. So there's certainly variability within individual landlords. You know, some may not keep up the property to be quality. They may not make those replacements or fix that furnace. Some may have economies of scale with operating and could save some money in that avenue. Others may truly have a charitable purpose. But no matter what, there's going to be some kind of floor that a landlord is willing to accept for rent. And that is just often unaffordable to many, many households within our community. And so even in this example, a $50,000 home is likely not going to be a quality housing unit. So you can imagine what this calculation would be for a higher quality housing unit that costs more of an investment on that front end. This then leads me to the final kind of like ground setting framework for today, market failures and but-for tests. We talk about this a lot in government, and so I kind of wanted to give a little bit of context about what we mean by that. So market failures can have a couple different definitions. First would be an inefficient distribution of goods and services in the free market. The second could also be considered like the tragedy of the commons. So essentially, individuals make the correct decisions for themselves and their businesses, but those decisions may not be in the best interest of the collective. So a good example would be like water access out in desert states. Many individual farmers are making the right, rational economic decision by using lots of water to irrigate their crops, which makes sense for them as the individual business, individual landowner. But if every farmer used up all the water, there would be no water left. So that's a market failure. The third is what we just discussed, and that's the failure of the market to kind of deliver like an optimal result. So the market may not be providing safe quality housing at a price that is affordable to many, many households within our community. So this is just one of those market realities, market failures that can't be corrected without charity or subsidy. And so that leads into this but-for test. So this is often used in government when we describe subsidy or any kind of investment that we're making in projects. Essentially, it's a threshold test that examines really whether or not a project could happen at all. And specifically, like a project could not happen but for this subsidy investment. And so that's kind of that is the threshold that we look at when we're looking to make affordable housing investments. If this project could happen without our subsidy, they don't need our subsidy. We're only looking to invest in projects that need the subsidy to provide a service that we're looking to invest in, like affordable housing, like subsidized rents, something that would be affordable to many households within our community. Okay, so now that we've laid the groundwork for our conversation about some assumptions going into the conversation today, let's talk through a couple of recent housing challenges in our community. The first relates to some financial challenges. So according to the United Way, at least 40% of Marion County households cannot cover the cost of living. So that's housing, childcare, food, transportation, healthcare, technology, taxes. They estimate that a household survival budget for a single adult in Indiana is about $26,000. For a family of 4 with infant and preschooler, it's closer to $73,000. Meanwhile, the median retail sales wages in Indiana are $13.80 an hour, which is just not a living wage. 61% of Marion County renting households earn under $50,000 in 2022, and 1 in 3 Marion County households spend 30% or more of their income on housing costs. And we'll get a little bit more into that later. Indianapolis is actually, we have the second most number of evictions in the country, second only to New York City. And to be clear, this is not an eviction rate. This is purely number of evictions. And so eviction increases the risk of homelessness, makes it more difficult to rent a unit, and especially a quality housing unit. We all know that there's been an incredible increase in housing costs in recent years. As of June 2024, the median home sales price in Marion County is now $263,000. This is $77,000 more than just 4 years ago in July of 2020. So not only are homes getting more expensive, inventory is less, and interest rates are making these mortgage payments even more expensive, making it very difficult to become a homeowner. And then we know that the legacy of redlining and discrimination is still apparent in Indianapolis. The median household net worth for white households in Indianapolis in 2017 was $171,700. For Latino or Hispanic households, it was $25,000, and for Black households, it was $9,500. Just a huge disparity there, and that is largely attributed to those issues of redlining that we had talked about before. So you may be thinking, Beth, this is all very depressing. Why should I care about affordable housing specifically? There's a lot of important work that needs to be done in education and food security, in public health, name your special interest area. I don't disagree, but my pitch to you all tonight is that stable housing is the foundation of everything. And if you only take one thing from this presentation, it's that. Myself and folks in the affordable housing industry would argue that first, housing is key to reducing intergenerational poverty and increasing economic mobility. And there's a couple of different statistics there on the slide. And then two, housing and neighborhood directly relate to life expectancy. Within Marion County, life expectancy varies by 10 years depending on the zip code that you live in. And what determines the zip code that you live in? Your housing. So that's my pitch to you as to why housing is so important and why affordable housing is so important, and especially quality affordable housing, because your housing also exposes you to health hazards like lead-based paint, radon, mold, asbestos, lots of toxins. So now that was a lot to get us started, but I wanted to start the discussion with the why behind affordable housing before diving into the who's, the what's, and the how's. So now that we've gotten our ground setting, we have our why, let's get into some of the nitty-gritty of grants and how subsidy works. So my team is responsible for managing approximately $25 million each year in federal funding for housing and community development initiatives. The programs that we'll discuss today all come from the U.S. Department of Housing and Urban Development, or HUD, and they include the Continuum of Care, the Housing Opportunities for Persons with AIDS, or HOPWA program, the Home Investment Partnership Program, or HOME, and the Community Development Block Grant Program, CDBG, and the Emergency Solutions Grant, or ESG. There will be no quiz at the end. You don't have to worry. Each of these grants comes from HUD, and they're all dependent on the passage of the annual federal budget. So if you remember when the federal government shut down, that directly impacts our work. We can't get the approvals we need from HUD. Projects can stall. We get about $9 million a year in CDBG. It's our most flexible funding source. We get about $4 million in HOME, and that specifically has to be used for affordable housing, whether it be home ownership or rental. Here are a couple of examples from projects in town that have either been HOME or CDBG funded. It includes trail extensions like the extension of the canal towpath to the Fall Creek Trail, historic rehabilitations, and affordable rental and home ownership. In the ESG program, that has to be specifically for homelessness initiatives like shelter operations. We get about $800,000 a year. And then in that HOPWA program, that can be used for housing assistance, both mortgage and rent assistance for households who have been diagnosed with HIV or AIDS. We get about $2.3 million annually. All the grants that I just discussed are what are known as formula or entitlement grants. We get these every single year from HUD based on population, poverty rates through a formula that HUD has established. As long as we stay in compliance, we keep receiving these dollars. The Continuum of Care is different. We have to apply every single year for this funding source, and we have to compete with every other community in the country to get this resource. And it is our largest resource that we have for homelessness initiatives. Here are a few of our partners for ESG, HOPWA, COC, and also we have a youth homelessness demonstration program. So we work with lots of different nonprofits in town. And I also want to acknowledge that this presentation, my perspective, is really just focused on the grants that we discussed. We are not going to have time to get in the weeds of a lot of these other funding sources, but it's good to be aware that there's other funders and programs in this affordable housing space. A lot of the concepts may be similar between and across grants, but sometimes they aren't. It's a complicated, nuanced industry. So when you have developers who are coming to your community to do affordable housing, please don't be afraid to ask clarifications of them. There's a lot. Questions are good. Okay, so now let's dive more specifically into affordable housing for home ownership and rental and how that works with subsidy. So first question, who does affordable housing serve? When people say affordable housing, it typically refers to housing that must be rented or sold to households with incomes less than 80% of the area median income. So if you can remember back to your statistics class from high school, and you remember that bell curve, the median would be right in the middle of that bell curve. It's different from the average, but it's the middle of that statistical bell curve. So 80% is 80% of that middle amount. So it's a little bit less than the median income. HUD also has different income levels depending on your household size, as you can see on the chart. So the Simpsons, being a family of 5, they would be eligible for our programs if their income fell below $88,900. Bert and Ernie, They would be a household of two. They would be eligible if their household was below $65,850. The next question would be, what is considered to be affordable? HUD has defined that households shouldn't spend more than 30% of their monthly income on housing costs. So for home ownership, that includes principal, interest, taxes, and insurance. For rental, that includes both your rent and your utilities. HUD considers households who pay more than 30% of their monthly gross income towards housing to be housing cost burdened. If you're spending more than 50%, you're considered severely housing cost burdened. So those are two concepts that HUD has established and we follow with our policies as well. I didn't get a chance to update this data, but it's from 2019, and 49% of Marion County renter households are housing cost burdened. So that's 30% or more. Over a quarter of Marion County households are paying more than 50% of their gross monthly income on rent. So you can see that we had an affordability challenge then, pre-pandemic. So I can't even imagine what it must be now. Another important thing to keep in mind, different programs have different rent limits. I don't know why, it's confusing. Some of these affordable housing programs come from Treasury that we're not talking about today. The programs I deal with HUD. They have different rent limits sometimes. It's bizarre. The federal government doesn't always make sense. So the table below is specific to the home program, and these designate low home units as units for households below 50% of the area median income, high home units for households at 60% of the area median income at lease up. But wanted to give you a sense of what kind of rent limits we're looking for. And this has to be the ceiling, including those utility payments. So if a developer is anticipating $150 a month in utilities, the rent has to be, I'm going to say, $965 minus that $150. So that's how that calculation works when we're talking about affordable rents. This is the ceiling, including utilities. Talking about that nuance, I know I'd said I was not going to talk about some other programs, but I am temporarily. So the low-income housing tax credit program is one of those programs I mentioned. We're not going to cover it in depth, but that program has some slightly different rent limits. But the reason I want to bring it up is that it is the largest funding source for affordable housing. It is run through the state, the Indiana Housing and Community Development Authority. And if you are aware of any affordable rental housing projects in your community, it is most likely that it is low-income housing tax credits and then maybe a little bit of city subsidy. So that's why I wanted to bring it up. If you have questions about that program, IHCDA has a website that has lots of information, but I wanted to acknowledge it as well. And so you can see on this chart, they provide rents that go all the way down to 30% of the area median income, which would be the lowest rents. All right. So now that we've covered the who and the what, let's get a little bit into the how. So how does rental subsidy work? So let's say my department has $500,000 of home funding to invest in affordable housing projects. Let's say, for the purposes of this discussion, that the market rent, completely unsubsidized private development, that market average rent, let's say, is $1,275 for a one-bedroom unit. That's a project that private market would do, a bank would lend to that, a developer could do that without any subsidy at all if they're using that market rent. If you compare the rents from my prior slide here to that market rent, you can see the difference between those rent amounts. So for a 30% AMI rent limit unit, you can see there's a $579 difference per month in the market rent versus the affordable rent. And so you can see that difference all the way down. Oops, I think I got these flipped up. Yeah, here we go. A $696 difference per unit compared to the market rate for the lowest rent limit, $310 for that little kind of middle one, and then $130 difference for the mid one. And so that difference between what the market rent would be and what an affordable rent could be, that is one way to think about subsidy. And I want to acknowledge this is kind of like a gross oversimplification of underwriting, but to kind of empower you guys to kind of see, how are developers doing these deals? What does it mean when I see in the news the city's invested $1 million in a project? What does that really mean? So one of the policy decisions that's debated within our field comes down to depth of subsidy versus the number of units created. So if we have limited resources available, we only have $500,000, Should we invest in more units at a higher rent or provide deeper subsidy to fewer units? So in this example of having $500,000 of home available, the understanding that subsidy would be the difference between market rents and affordable rents, we can either invest our subsidy in 4 units at the very low income rents, those 30% AMI rents, which requires more subsidy per unit, and rents can only go up to $579. Or we can invest 20 units at the 60% AMI rent limits. That requires less subsidy per unit, but those rents can go up to $1,145. So that's a little bit of how rental subsidy works. Some of those policy decisions on should we provide fewer units at a deeper rent to higher need populations or more units at a higher rent amount. And that's an ongoing philosophical policy decision. And at a high level, that's kind of how rental subsidy works. We can dive into some questions at the end because I know it can be confusing. So a little bit of that math to kind of walk you through it. Again, this is a back of the napkin way to think about subsidy. It's not the absolute. Please don't put my name associated if you are ever get into underwriting. I'm not a teacher in that. But you can think about it as the difference between that market rate rent and the affordable rent times the number of months in a year, because you make rent payments every single month. That's the per unit subsidy need per year. So in our example, we had 696 times 12. That's 8,000 and some change. Plus, and then it's the per unit subsidy need per year times the number of years of affordability period, which we'll get into in a little bit. That's the overall subsidy per unit. And that's number is $125,000 of subsidy need per unit for the overall project. And then that times the number or the total funding that we've committed, $500,000 divided by 125 got us that 4 units. And so this will make more sense once we get into affordability periods in just a little bit. Now I'm going to pivot. We're going to talk about home ownership. So clear rental from your mind, we're on home ownership. So let's assume we have the Smith household. The Smiths, given current interest rates, family of 4, they can afford a $125,000 house. Within home ownership, we have 2 different kinds of subsidy. We either have development subsidy or buyer subsidy. First, I'm going to talk about development subsidy. So the Smiths can afford $125,000. It is very possible that it costs $200,000 to build a 3-bedroom, 2-bath unit in a neighborhood in Indianapolis. Let's say that it appraises for $125,000. No private developer would ever do this deal. They are losing money because they're only going to be able to sell it for $125,000, but it cost them $200,000 to build. So that's where subsidy comes in. This project would not happen but for our subsidy. This construction would not happen. So the Smiths can afford this house. We just needed to subsidize the construction. So that's one way affordable housing home ownership subsidy works. Let's take that very same house. It costs $200,000 to build. Let's plop it in a different neighborhood in Indianapolis. As we know, different markets, it costs different amounts of money to buy the same 3-bedroom, 2-bath house in different neighborhoods within our city. That same 3-bed, 2-bath house could appraise for $225,000 in a different neighborhood. That's a deal the private market would do. They would make money on that. They're interested in that $25,000 profit. However, the Smiths can't afford that. That's a big difference between what they can afford and what the house would sell for. So in this instance, the Smith household would need $100,000 of subsidy to afford that house. But our programs, we have a standard developer fee baked in because we want to make it fair for all of our nonprofit partners, regardless of where they're building, that they get the same amount of money to build the house, no matter what neighborhood they're working in. So the Smiths, part of their subsidy would be this $25,000 profit. So the city subsidy to get this project done would be $75,000. So depending on different markets, the subsidy on like an Excel sheet looks a little different, whether it's a buyer subsidy to the Smith household or a development subsidy to get the project built in the first place. But that's how home ownership subsidy works for affordable housing, that buyer versus development gap. Okay, so I had mentioned this a little before, I teased it. Affordability periods. This is the number of years that a project is required to remain affordable. Different programs have different affordability periods, and there are different requirements for home ownership and rental projects. Typically, and this is typically, rental projects have affordability periods in Indiana between 15 and 40 years. Homeownership projects are typically between 5 and 15 years. It depends on the amount of subsidy per unit, and it depends on the different program that it may be a part of. Rental projects require that all new tenants in affordable units, so if you're leasing up a project, they're required to be income qualified during the affordability period. So every single time there's a new tenant within that 15-year period, that landlord has to make sure that they're income qualified to lease that unit. And then every single year, residents who live there must recertify their income. And typically funders like DMD, like the State Housing Authority, IHCDA, they will complete inspections every few years to ensure that the housing meets the requirements of the program. Otherwise, we may require that developer to pay that subsidy back if they aren't meeting the rules of the program. And I know people get all excited about ribbon cuttings and new investments, but truly, like the bread and butter of affordable housing, the thing that makes affordable housing affordable is compliance. And it's not sexy, but it is true. Like, it is not affordable housing if the second tenant who lives in that unit is anybody. You know, it has to be income qualified throughout that entire affordability period. And that's super duper important. Home ownership has some slightly different requirements, but there's still lots of requirements. Homeowners must take a HUD certified homebuyer education course. They must utilize the property as their principal place of residency. Basically, that means they can't rent it out to somebody else and they can't use it as an Airbnb. They have to live there. They can only utilize certain types of mortgages. We don't allow homebuyers in our programs to use adjustable rate mortgages, mortgages that have balloon payments, that type of thing. And the reason is we want to make sure that homeowners will be able to maintain homeownership sustainably over the course of that mortgage. And those types of products can be unpredictable. So we want to make sure that we're setting up these homeowners for long-term sustainable homeownership. And if a homeowner moves during the affordability period, like if they get a new job in Louisville and they have to sell their house, there's a couple different things that may be required, and this is where it depends on the program. Most often, homeowners must repay the subsidy utilized to make the home affordable, and they do that out of the sales proceeds. So most of the time, we are not getting a check cut from the homeowners for the subsidy. It comes out of when they sell their home, they pay back either all or a portion of the subsidy. The other option that sometimes happens is that they may have to sell to another income qualified home buyer, and often at a price that's less than market rate, because it would need to be then affordable to that income qualified home buyer. So that's what happens if a homeowner sells during that affordability period. In order to participate in these programs, households have to agree to do an income qualification. This is how we ensure that households are actually income qualified and that we aren't being tricked into just believing that they fall below a certain income level. This is a HUD requirement, and they have very specific rules about documentation. Households are required to provide, and this is literally more than it takes to qualify for a mortgage from a bank. We have to get 6 months of checking account statements, 2 months of pay stubs, 2 months of savings account statements, 2 months of Venmo, PayPal, Cash App, retirement account statements, most recent tax return, and more. So it is a lot of documentation households have to agree to provide in order to benefit from these programs. All right. So we're now going to pivot away from affordable housing construction and move into an overview of the Continuum of Care and the homelessness response system in Indianapolis. So the Continuum of Care is a community-based collective impact approach built on the belief that the best solutions to ending homelessness come when we work together as a collaborative community rather than separate entities. The Indianapolis COC shares the vision that everyone has the right to be housed and connected to care. And I'm going to acknowledge it gets a little confusing because there's that collective impact model COC, but then there's also this grant funding source that is called the Continuum of Care and COC. So it can mean both of those things. Again, this is a federal government. I don't know why they did this, but just know that it means both the grant and the collective impact model. The HUD Continuum of Care grant is designed to provide funding quickly to rehouse homeless individuals, families, people fleeing domestic violence, youth, and also focused on minimizing trauma and dislocation caused by homelessness. It's also to promote access and effective utilization of mainstream programs by homeless individuals and families, and to optimize self-sufficiency among those experiencing homelessness. So the COC grant that the city received last year was about $12 million, and those dollars were deployed through that collective impact or continuum of care approach. So it's those partners who are involved and the grant. The COC grant requires that all projects in the COC use the Human Management Information System, also most often referred to as HMIS. All clients served by the COC must come from the Coordinated Entry System, or CES, and all providers must follow Housing First. We'll get into these three buckets over the next few slides, but these are the fundamental requirements of being eligible for COC funding for those nonprofits who are involved in that collective impact approach. So first, what is HMIS? It is a local information technology system used to collect client-level data and data on housing and services for individuals and families at risk and experiencing homelessness. Essentially, it's the tool that case managers use to track households experiencing or at risk of homelessness and their outcomes. And every nonprofit who gets COC funding uses this, so it is not siloed in the way that a lot of other programs may be. Coordinated entry is a system that is used to connect people who are at risk of or experiencing homelessness to housing resources. Through the coordinated entry system, all households in need of homelessness services can be connected to providers through a centralized assessment process. So essentially, there's one assessment tool used to determine vulnerability, regardless of which nonprofit partner someone may be working with. So it's the same assessment tool across the continuum of care. And we have limited housing resources, so this is a collectively agreed upon tool to determine vulnerability and connect people with available resources. So it's essentially an agreed upon framework for assessing vulnerability and connecting the most vulnerable with housing resources as soon as they become available. So someone may be connected to the system in a moment of crisis. Depending on their needs, they may not even end up going into the coordinated entry system if we're able to use some of those diversion or prevention tools. So like very short-term immediate rental assistance payments if they just got behind, but then they've gotten reemployed. That would be an example of they don't need to go into CES. They just need to have a prevention tool so they don't end up in eviction court. If they do need more intensive services, the system is used to assess, prioritize, refer, and navigate clients through a very complicated system. These households who are in the system have case managers who assist them through the process, get the required documentation like a birth certificate or other documents that may be required to eventually rent a unit. Then the households are connected to the tool that's the best fit for that household need, whether that's permanent supportive housing with intensive wraparound services. Maybe it's affordable housing with fewer services. Maybe it's rapid rehousing. There's a couple different options that may be the right fit for that household. The other requirement of COC funding is using a housing first model. This is a framework, I did not mean to do that. There you go. This is a framework that prioritizes providing permanent housing to people experiencing homelessness. It's guided by the belief that people need the basic necessities like food and a place to live before they can work on anything else. They can't focus on getting a job or budgeting or substance abuse issues until they have those basic needs met of food and housing. So it does not require or mandate participation in services to get into housing or to retain housing. Really, fundamentally, you can think of it as the belief that the solution to homelessness is housing. Now that we've talked a little bit about the continuum of care and the requirements, I also wanted to spend a bit of time on the point in time count. This is conducted by CHIP each year. That's the Coalition of Homelessness Intervention and Prevention. It's a convening organization for the overall continuum of care. They conduct the point in time count each year, and they have lots of community volunteers who participate. And it's essentially a census of homelessness within our community. It's conducted in January, and this data ends up getting submitted to Congress to inform federal policy And it's also used as a way to see how we're doing in addressing homelessness. So CHIP just recently released the 2024 data. On January 4th, 2024, which is when the pit count was conducted, 1,701 neighbors were experiencing homelessness. This is a 5% increase from the 2023 pit count, and 339 of those neighbors were unsheltered and sleeping outdoors. The data also showed that Black residents are overrepresented among neighbors experiencing homelessness. During this pit count, 53% of those counted were Black, compared to only 30% of the Marion County population. So this is a major focus area for the Continuum of Care over the next few years, is how to reduce this overrepresentation. So clearly, there are some major issues within our community. We have a lot of nonprofit partners, and we're very lucky that we have so many community partners who are collectively agreed that this is a problem and we all want to address it. So to wrap up the presentation, we'll discuss a couple other challenges and then also some accomplishments so we can end on a little bit of a happier note. So some challenges that have been an issue recently. Number one, inflation has had a major impact. Interest rates are creating challenges for developers. It is requiring more subsidy to do the same size project from just a few years ago. I would say pre-COVID, our typical subsidy amount would be maybe $500,000 for a multifamily, I'm going to say 40-unit project. Now it's closer to $1 million is kind of the standard. So it is significantly harder to get these deals to the finish line. And this will tie in, we are getting fewer resources from the federal government to do so. It has also been difficult for homeowners to compete in this real estate market, given limited supply, challenges of interest rates. Another, quite frankly, HUD changes the rules on us, and it can be difficult to adapt to some of these rules that feel like they're created outside of the real world. So that's something that us and our nonprofit partners struggle with pretty regularly. So when I had mentioned federal funding decreasing, we've been doing a great job with COC. Some of our other grants, like the Community Development Block Grant or HOME, which is for construction, those have seen decreases. So this shows our CDBG allocation from 1990 until 2021. You can see it's generally been above $8 million a year, with a peak of about $12 million in the early 1990s and early 2000s, or late 1990s and early 2000s. But when you adjust for inflation, that $9 million from the early 1990s, that went a lot further than $9 million today. So it is trickier to get these deals done. It is difficult. It's a tough industry to be in right now. So I definitely applaud our partners who are able to get these projects done. It is a major accomplishment. We need housing. I didn't want to end the presentation on some bad news, so I'll wrap up with some of our department's accomplishments over the last couple of years. So in 2024, we were awarded $11.9 million of COC funding. So that's the one for homelessness. And that's a 20% increase from last year's award and 170% increase since 2016. So we have been scoring very well nationwide in our homelessness response system, and we want to continue to do so so that we can bring this really vital resource to our community year over year. And that's thanks to the good work of our partners who are housing, who are doing these services and really doing the hard work to be able to continue to house people and get these resources. From the construction side of things, between 2016 and 2024, with CDBG funds, we've developed 555 units of affordable housing. With HOME, 487. We've also invested in nearly 350 permanent supportive housing units across our whole portfolio. So that's not just HOME and CDBG. We have a couple other resources within DMD. But those permanent supportive housing units, that's kind of like the gold standard for housing with homelessness. That provides safe, quality housing paired with intense, optional, but intensive services. And that's the best solution to ending chronic homelessness is permanent supportive housing. So the fact that we've been able to invest in nearly 350 of those units is very exciting. And when you think about our overall scale of 1,701 neighbors, that is a meaningful impact. And this is why this work is so important, is that Indianapolis collectively, we can do hard things and we can make a dent in some of these challenges. And then finally, since 2016, we've invested in 449 new home ownership opportunities. So if you're interested in learning more, you can visit us online. We have our indy.gov website under community development grants. And if you're really into it, you can learn all about these grants, policies, and procedures, the real nitty gritty. If you're learning or interested in learning more about the Continuum of Care, please check out CHIP's website. They have a bunch of dashboards available, and you can see exactly how the system is performing and serving our most vulnerable residents. So I just took the snapshot literally from this afternoon for permanent supportive housing. You can see our utilization rate is at 100%. We have no vacancies within permanent supportive housing, and we've only had 9 returns to homelessness. So that is one of the benefits of using that HMIS system, that CES system, is that we have a real-time, transparent check of how we as a system are doing, and we have accountability with our peers to make sure that we're providing the best possible services we can for our neighbors. So I highly recommend checking out CHIP's website. They have lots of resources available. So with that, I want to thank you all for your interest in affordable housing and spending your evening with me learning about some kind of dry grant topics. But with that, I'll stop sharing my screen and open it up for any questions.
That was awesome. Yeah, a lot of definitely a lot of information, but really insightful with some of those statistics that you gave out. That was like, wow, had no idea. So definitely great information. Any questions from the audience first? If you would please come off of mute and ask your question.
Hello,
Hello.
my name is Josh, and I am a real estate agent. I am a construction company owner. I'm looking to develop affordable housing and workforce housing for the city of Indianapolis. And I guess I'm here to kind of see how I can accomplish.
Josh, I think you went on mute there for a second, but it sounds like you're interested in kind of getting involved from the builder developer perspective. Is that fair?
Yes, ma'am. So I have my real estate license. I have a construction company, and I'm looking at becoming a developer of affordable and workforce housing. So I don't know. I'm here to learn as much as I possibly can, but to find out how I can facilitate that moving forward.
Yeah,
Hopefully, I'm.
absolutely. Yeah. Thanks for joining tonight. So I'd say a couple different things. One, federal funds require that any of our nonprofit partners or any of our development partners, they have to competitively bid projects. So if you are interested in being the builder on one of these projects, I would say reach out to some of the community development corporations in town. They have maybe a home contract or a CDBG contract. They may be building single family homes that then need to be developed, and to be on that list to then learn about new opportunities for building and bidding. The other thing I'll throw out there is the state of Indiana, the Indiana Housing and Community Development Authority, IHCDA. They have a pretty new emerging developers program. So if that's something you're interested in, I can try and pull that link and send it around as well.
That would be helpful. I've met with Martindale Brightwood, and I'm at I think Inglewood. They just tried off of New York and rural. And then I thought I reached out to somebody in the for the emerging developers, but I don't know if I've got the right contact information.
Okay, yeah, you've named a couple of our partners. One place I'm trying to think of other partners. We every year have to submit what's called an action plan to HUD, and that outlines every single project that we want to fund. So if you're interested in kind of being on the front end of what projects is DMD going to be funding, I can send a link to our action plan, and that'll kind of give you a heads up on like, okay, this nonprofit partner is going to have this development project in the next 6 months. Maybe I'll reach out to them or something like that. So I can send the link to our action plan as a starting point.
Yes, that would be great.
Okay, perfect.
Thank you, Josh. Any other
Yes, sir.
questions?
Hi, can you hear me?
Yes.
Hi, I'm Vidya. Nice to meet you all. Thank you so much for this nice presentation. I'm a public health professional. I work at IU as in a clinical research. I have my background in public health. I have did my master's in public health in epidemiology and biostatistics. And I'm a foreign trained dentist. Actually, I'm looking for some opportunities to volunteer. And I wanted to ask, is there any opportunity at this place that I could like volunteer maybe with data handling or whatever, like research assistant or anything that I could help you with? Like I can share my LinkedIn profile or maybe my resume if you want to go through. And I have Denny's email ID. Maybe I can send her out that and then you can just look at it.
Yeah, I can tell you for pretty confidently, I think CHIP often needs volunteers for data cleanup because a lot of their job is cleaning up data from the whole COC system and trying to like get it all to work within the HUD systems. So I know that they often have a need around data. So I'm happy to make that connection. If I don't know if it's easiest to share your contact information, and I can connect you with the right folks at CHIP.
Sure. Thank you so much.
Yeah,
I
thank you.
appreciate that.
Thank you. That's awesome. Thank you. Any other questions? I see a hand raised by Reed IA meeting. Oh, no, that's not a hand raise. I'm not sure what that is. Oh,
They're clapping.
okay. Beth, I have a question then. I'm not sure if this is the right term, but let's say that they built homes or condos on Mass Ave, and that would be basically high-end, upper high-end living. Is the term called mixed income housing? Does that exist in Indy?
Yes, definitely. So
Okay.
I'd say mixed income would be if you have some of the development has some affordable units, and then there'd be market rate units. So that
Okay.
does exist within Indianapolis, especially like a lot of the larger projects, a lot of those ones that are funded through that organization I mentioned, IHCDA. That's pretty, especially when it gets more difficult to fund these projects, having some market rate units makes it more possible that the deal can get done because they have a little bit more cash flow and can then subsidize some of those affordable units. So yes, you're spot on in terms of mixed income housing is definitely part of the landscape.
Mixed income housing. Okay. All right. Are there any other questions for Beth? I have another question too, Beth. You were saying that the government process, as far as paychecks, account balances, you said that process was way more in depth than what the banks are requiring.
What I've heard is that we require HUD requires more documentation to qualify for our programs than it even takes to qualify for a mortgage from your standard bank. Just with the depth of documentation that's required, the number of months of checking account activity, we get really in the weeds if it comes to if you've won the lottery or if you have any kinds of like trusts. So yeah, our team sometimes feels like we're private detectives searching through
Wow.
this stuff when really we want people to be eligible. We want people to benefit from these programs, but the federal regulations require what they require.
Okay. And do you all run out of funds at the end of the year, or do you roll over? How does that work?
Yeah, so it does get a little funky with the grants, the way that they work. So we every year in that action plan that I had mentioned, we obligate all of our grant dollars. Sometimes projects may fall through, sometimes things may change or they don't spend as much as they anticipated. And in that instance, then it would roll over. So we do have a competitive application process each year for developers and nonprofits who are interested in applying for the subsidy. So that application happens typically at the end of August each year. And then we have another one that aligns with the state's housing development program, and that happens around May. So those are two big application cycles each year.
All right. Are there any other questions?
So, I'm sorry, Beth, is that something that I should be looking into with that application for my company, or?
Yeah, if your organization is interested in directly receiving these dollars, there are some certain requirements that come along with it, like certain audit requirements from the federal government. But if you're interested in that, I'm happy to share my email. If you want to, I can connect you with some of our grant managers to kind of walk you through what that application would look like. And then previous year's applications are available on that website if you kind of want to take a look. So I would say both avenues are options for different organizations in town, whether that be a direct recipient of these grant dollars, or if you're more interested in like the bricks and sticks construction, being a builder on the projects. Both are options.
Okay, yeah, that I think that I'm open to either option currently, and I wanted to kind of see where I would best fit on either side. Because with me being a real estate agent, I see deals that come up within the city of Indianapolis that, you know, are just vacant lots and land. And I wanted to create some type of housing for communities. So either way, I think I'd be happy.
Awesome. Yeah. So I just shared my email in the chat. If you want to reach out, I'm happy to connect you with some of our grant managers who can walk you through more of the nitty gritty of home and CDBG.
That's awesome. Thank you very much.
Beth, are the homes that you're talking about, are they suburbia or urban?
So anywhere within the city of Indianapolis is eligible. We can't use these dollars for Southport, Beech Grove, Lawrence, and Speedway. Those are excluded communities. They have to go to IHCDA if they want to access these grant dollars because it's one of those fun perks. But
Okay.
otherwise, anywhere within city limits are eligible. I would say typically just due to the infrastructure, the community development infrastructure that we have of community centers, community development corporations, those are largely closer to the urban core. So many times it is more urban than suburban, but we do have some partners who are now exploring some mortgage products, so more of that buyer subsidy, and those households can purchase any house on the private market, and that can be in any of those townships. So we have a little bit of variety for sure.
Okay, great. All right, going once, going twice. Beth, I want to thank you again for facilitating this session tonight. Very informative, a lot of information. You are definitely an expert at what you do. At the way you were rattling off those those requirements, I think you did an excellent job. So I definitely think any of us would feel like we would we would be knocking on the right door coming down to your agency, because you definitely shared some very in-depth and meaningful information tonight. So if we don't have any other questions, I'm just looking at the chat just for a second. Have a great evening. If we don't have any other questions, we'll go ahead and wrap it up. And again, thank you so much for sharing your time and just the information from D&D. We really appreciate it.
Yes, thank you all for having me. This was fun.
Sure, good deal. So next month, August, the third Tuesday in August, we will have the guest will be Indie Hunger Network. And so they will come in and talk about their community services and even some of the resources that they provide through the Hunger Networks. So the third Tuesday in August, we will see you then. Thank you so much. Have a good evening.